if you're going to get a nasty correction, it usually comes not only in the 7th year of the decade, but in the second half of the 7th year of the decade, i.e. round about now. And then the decade usually ends with a bit of a rally again from quite a low level. The last decade, if you can remember, it worked pretty well. The bear market started in the 7th year. The worst of it was in the 8th, and the 9th year clearly ended the decade with a jolly good rally. If there's going to be a crash, it's quite likely to come in this period of time, in the 7th year of the decade. And the one I've got in mind, pretty much as a role model, is 1987. 1987 was in the early stages of a much longer-term secular bull market. I'll come on to the secular trend in a minute. That had begun in 1982. It was the Thatcher-Reagan years when capitalism was looking pretty good. And it went all the way up to the end of the millennium, basically. So 87 was early on in that secular uptrend, and yet nonetheless, you came on into your office one day in late September 1987, and the whole market was down 25%. How did that happen? There didn't seem to have been an event, no missiles firing anywhere, and yet the market could do that to you. And of course, people with hindsight explain, well, there were program trading and all this sort of thing.
Yeah, right.
So there was a mechanism that encouraged the move, but it started anyway, basically. Cogwheels, the way markets work, are quite capable of doing this. And then, of course, it regained its cool, and a year later, you could hardly find on the chart where the crash had been, but it was a crash, definitely a crash. And markets are vulnerable to crash if they're expensive to start with. Something that's cheap is inherently less likely to fall very far because the floor is close underneath it. So the markets where you fear a crash is where the valuation basis is extreme. And the largest market where that is quite clearly the case now is the USA, where the CAPE or the Shiller, however you look at the numbers, and you can dress them up different ways. And analysts always like to be bullish, so they'll give you forward earnings estimates. That looks like artist imagination to me some of the time, but they'll try and get the number down. But however they try it, it is by its own historic yardsticks extraordinarily expensive. It's also vulnerable in another way, in that it isn't most of the stocks in the market that are holding the index up. It's incredibly few, and the acronym FANG-T has been working. FANG has got 2 A's in it, one for Amazon, the other for Alphabet, and T is Tesla. Those are the stocks that have been holding the index up. The stocks that used to be regarded as the backbone of the market, IBM, Walmart, General Electric, etc., they're quite clearly not in a bull market at all and haven't been for quite some time. So it's vulnerable.